Joe, Ellie.
All right, I think we're getting everybody in. Welcome, welcome, everybody.
Hey, Julie, can you hear me?
I can hear you. Hey, Stephen, how are you?
Steven,
Hey, what's up, Edwin?
how you doing, pal?
Good, man. Good. No complaints from over here. How are you?
Good, good. You just like Chris would say, blessed.
That's right. That's right.
Living the dream.
Yeah.
Yes, sir. At least trying.
All right. So we'll I got the recording going. Welcome everybody. Welcome to Dropping Jewels. And today we have Stephen with us. I have my co-host Edwin. Thank you all for coming. Stephen, we got somebody joining us all the way from India, bro. So can't they heard that you're the
Yeah,
You're the movie
and
king. So Suri's here with us from India, so he's joining. So welcome, Stephen. Welcome everybody. Turn it over to Stephen to get started.
Well, you
thank
let me
you.
know. Ready to start? Do we want to allow anyone else to join? I don't know if there's, anyone else we're expecting.
A lot of people signed up. I got a lot of responses and in my GHL. So
So, I'll just start a little bit about myself before I kind of dive into the meat and potatoes.
let's
Uh,
do it.
for those that don't know me already. So, I'm a mortgage broker. I've been in the mortgage industry for it'll be 10 years in January. Since I started, I've always only operated in the non-traditional mortgage space, meaning, I'm sure many of you are familiar with DSCR loans. Obviously, many of you are in the sub two community, so you're familiar with creative financing. And so, really, my background is in non-traditional mortgages. I've always been fascinated by solving problems, but B, I always believe that in business, it's always, or not always, but it's important to pick a niche, be good at it, and help that, use that to grow your business, right? Be good, know what you're good at, and not try not to be a jack of all trades. I think, and I'm not personally a student, sub two student, so I'm not a student of Pace's community. However, I am familiar with a lot of what he teaches, and I believe that one of the things he mentions often is the shiny object syndrome. So it's very easy to say and that you want to learn a little bit about everything to try and do a little bit of everything. Um, but I'm a very big proponent of find what you're good at, pick your niche, dive headfirst into it, and let that be, the way you run your business. So with that being said, I'm very familiar with DSCR loans. So for the past 5 years, that's probably been 90% of what the type of loans I originate. I do offer bank statement and profit and loss loans as well for entrepreneurs. Essentially, any kind of loan that you're looking for that doesn't require tax returns, I can get that done. So at the crux of the Morby method, and I'll start talking a little bit about it now, is the DSCR loan. So I guess and I kind of like to do interactive conversations. Who here has heard of the Morby method? How much background and insight do we have? Tell me a little bit about, if anyone could just give me a thumbs up, they've heard of it, they haven't heard of it, thumbs down if they haven't heard of it. Just yeah, feel free to jump in. Chris has heard of it, Joel has heard of it, Julie has heard of it. All right, so a lot of you have heard of the Morby method. Has anyone here completed a Morby method deal? Nope,
Nope.
no one's completed.
No.
Okay. So I'm gonna go ahead and guess that everyone probably has a general idea of what a Morby method is and how it works. I'm still gonna go over it. And then anyone can jump in, guys. I'm an imperfect person. So if you hear something that I said wrong, jump in and this is a collaboration here. We're all working together. So the Morby method, it is an acquisition strategy. It is a way to acquire property. And so the goal of the Morby method is little to no money out of pocket, and or in some cases you can close and receive funds in your pocket. So you can actually walk away from closing with cash in hand and having not used any of your personal assets to qualify. And so the way the transaction works is that you take a debt service or first position loan. Almost all of them are done with a debt service loan, a DSCR. And then you take either a seller second position or the seller takes preferred equity position in the LLC for the remaining portion of the equity. So to use percentages, let's say you take an 80% DSCR loan, you would then take a seller's 20% equity position to equal your 100% financing of the purchase. Now, in that specific instance, the buyer still needs to come in with closing costs. So now it's still using some funds out of pocket. You're still having to bring in funds to close. However, having to bring in 20% down on a DSCR transaction plus closing costs is very different than just bringing in closing costs on a transaction. Now, I have structured deals where the seller not only carries the down payment, but they carry the down payment plus closing costs plus cash proceeds at the time of sale. And so just very rough over the top, that's what the Morby method is. It's an acquisition strategy that combines DSCR financing and a seller carry position to minimize how much you need to bring to closing and or potentially fund you the day of closing. The goal here, in my opinion, and the way most people are structuring this is the ability to scale. You can purchase much more property this way if you're not having to shell out 20% every time you buy a house, 20%, 20%, 20%. And so there is huge pros in that you can scale very quickly, acquire a lot of property. If structured correctly, those properties should all still continue to cash flow based on whatever expected rents the property has and or based on whatever intent, whatever your exit strategy is with that property. So it's very important when underwriting a Morby method deal to make sure that you're underwriting it based on your total combined expected debt load and what either the pro forma is going to be for the property or what you expect to do to the property in terms of its long-term outlook. Jenny, go ahead. I see you have your hand up.
Yeah, you just mentioned, Stephen, something about net proceeds. So net proceeds to the seller, or you mean net proceeds to the whoever is purchasing?
It would be net proceeds to the buyer. And
To the
so,
buyer. Okay.
so in the most recent Morby method deal I closed on, we actually closed and the buyer walked away with, if I'm not mistaken, close to $60,000 or $70,000 cash. Now, today is kind of more of an overall understanding of the Morby method. How does it work? What are the pros and cons? And there are cons, and we're going to go into it. And then I believe Julie is graciously said I can join her next week on Dropping Jewels, and we'll do a case study where I'll actually bring up the exact numbers for that transaction, what my buyer's intent is with the property, his exit strategy, and how that's going to work out long term for him. And so, yes, but to answer your question, I did say net proceeds, and it is net proceeds to the buyer. And so to use, again, rough numbers and that an example for a Morby method, I'm going to use $1 million purchase price. And we're going to do an 80% DSCR loan. So your first position loan is going to be $800,000. Now the seller has agreed to carry 30% of the sale price as their seller carry position, either in a second position note or a preferred equity position in the LLC that's buying the property. So now, for those of you that are taking notes, that math works out to 110%. We exceeded the actual sale price of the property. We're getting 800 from the seller. I'm sorry, 800 from the lender at 80% LTV and 30% from the seller. So without diving into the nitty gritty numbers, there is a 10% excess that's being financed in this transaction. Essentially, without taking into account closing costs and settlement charges and so on, the buyer at closing walks away with $100,000. Now, after you do the actual calculation, once we do like a true case study, we'll show exactly what the true net number is to the buyer. But effectively, the buyer in that scenario that I just presented is 110% financing. And so that is both a pro and a con. And so in this instance, the person financed 100% of the down payment, 100% of the closing costs, and walked away with funds. Now, I don't recommend that you take those funds and buy a boat. I don't recommend you go out and buy a car. Those funds, and to properly, in my opinion, execute a Morby method should be used to renovate the property, force appreciation, increase rents. All of these things are going to be used to help in the instance of when it comes to disposition of the property 3, 5, 7 years from now, either via a refinance or a sale. At that point, you will have accumulated interest paid down on the mortgage. You've gained in terms of appreciation. If you forced appreciation by renovating the property, you now have more equity in the home, and you'll be able to refinance and or sell to pay off any outstanding debts and then net whatever proceeds are available at the time. So that's one of the pros right there, is essentially you get to finance renovations in a property if it needs it from the seller without having to take out a fix and flip loan. And so a lot of people are familiar with the BRRRR method, and the BRRRR method is buy, rehab, refinance, repeat. Essentially, you buy a property, rehab it, refinance it, and you do that over and over again until you've accumulated X amount of property and you've built your portfolio. One of the problems with that method is that it requires that you to come to closing every time with 20% down and renovate the property with your own funds. Or if you're not using a DSCR, you're using a fix and flip loan, you're closing on a 12% interest only fix and flip transaction, and you're paying interest only on those funds over the period of 6, 8, 12 months. And that interest only eats into or creates a large holding cost line item on your flip calculator when you're doing a fix and flip or a BRRRR method. Whereas if you could do a DSCR loan, do a singular closing and not have to do fix and flip closing, refinance into DSCR and pay 2 rounds of closing costs, you could do a DSCR purchase, use a seller carry position in the second position and or in a preferred equity position, and use that to fund any rehab you have for the property. In my opinion, that's a beautiful situation for a Morby method where you're able to realize all of the best possible outcomes. Now, I will say one of the cons to the Morby method, and this is all part of your underwriting and the diligence that needs to be done when considering doing a Morby method, is you run the risk of potentially over leveraging yourself. And if you over leverage yourself, come 5 years from now, when it's time for the seller's position to be paid back, there's typically a balloon. So a lot of you sub-2 students are familiar with, even in seller financing, when it's not a Morby method deal, there is a time at which you need to pay off the seller. There is a balloon position, and it's all based on whatever's negotiated 3, 5, 7, 10 years from now. When that moment comes, if you over leverage yourself at the time of the original Morby method, you may not have enough equity to refinance. It puts you at risk of default. And so it's all, part of how you underwrite the file or transaction up front. So in what instance is a Morby method viable, and how can you pitch the Morby method to a seller? So again, many of you sub-2 students, and if you aren't, you're familiar with sub-2 in general. Many sellers will ask for some sort of down payment as part of the seller finance negotiation. One of the biggest issues, or from what I've seen, one of the biggest problems when trying to negotiate seller financing is a lot of times sellers are asking for a large down payment. Their home is free and clear. It's worth $1 million. They don't want 10% down. They don't want 5% down, right? So for you to be able to negotiate with them, you need to be able to offer them a substantial down payment. They may agree to doing seller financing at a very attractive interest rate, 0%, 1 or 2%. They may offer a balloon over 7 or 10 years. All of those are great seller financing terms. But if you have to bring 50 or 60% down, many people are not willing to purchase a seller finance property if it requires them bringing 50% down of the sale price. So if you have, what's up, Jonathan? If you have a seller like that, you can use the Morby method as a great opportunity to say, you know what, I can bring you the 50% you're looking for. If you're willing to carry 50%, I can bring you 50% down. But it's all about reframing how you're going to structure the transaction. It's not going to be 50% down and the seller is going to be in first position. You're going to offer to bring them 50% down via a DSCR or first position loan, and they'll carry the difference. Now, one strategy that I like and Jonathan's familiar with this. One strategy that I like is putting the seller not in a second position lien, but putting them in a preferred equity position in the LLC that's acquiring the property. This, in my opinion, and I believe can be presented properly to the sellers, actually gives them even more security over being in second position. So it should strengthen your offer. It should allow you to feel more confident when making that offer that you're putting them in essentially a first position, but in a preferred equity position in the LLC. So you're bringing them the 50% via DSCR loan, and they'll carry the difference. And so what most people will do, instead of using 50% DSCR, they'll take a 60% DSCR. The seller carries 50% that they've already agreed to at their favorable terms that you've already negotiated. And we're back at the conversation we had earlier, where we now have 110% financing, where you've got your down payment, closing costs, and potentially net proceeds available to you to be able to fund whatever rehab that you need to do to the property, whatever you need to do to force appreciation, to be able to properly burr this without over leveraging yourself. Because conceptually speaking, guys, in that instance, if you really wanted to, you could take a 75 LTV DSCR loan and throw the seller's 50% on top of it. But I would highly, highly not recommend that unless you have a very good use case for all of those excess net proceeds, and you have a very strong idea of what your exit strategy is going to be at the end of the seller financing term. And so that's like a rough overview of how that Morby method can work. Very quick, fast, in a hurry walkthrough of the preferred equity versus seller second position, of how the LTVs would work. And so, I do want to allow for some questions. I want to go back and forth. Julie, Edwin, whatever, feel free to jump in. Let me know if there's anything you'd like for me to go over on the Morby method in general, and what other situations you guys think might apply, or how we can use this to acquire more property.
Can you answer why a seller would do this in the first place, and how would you overcome their basic objection as why should I carry off carrying back the loan? And second,
So it's essentially no different than the pitch for a sub-2 transaction. And so, generally speaking, these deals are done on pieces of real estate where there is some sort of need. There's some sort of distress. If, quite frankly, if the property's listed and it could have sold at list price quickly on the MLS or wherever it is, it would have. So if it hasn't, you've got a situation where either the seller may be asking for more than the market will support. And I'm not necessarily saying more than the market value, but more than the market can support. So I'm seeing in a lot of cases, and obviously I do a lot of DSCR loans, I'm seeing in a lot of cases, properties are appraising for list price. I'm refinancing and helping clients purchase property, and the appraisals are coming in at list. The appraisals are coming in fine. The problem is not that the property, quote unquote, value isn't there and it's not supported. The problem is that the market is not currently able to meet the requirements, meet the seller's list price due to the current interest rate, due to people being concerned about where the economy is going, right? There's a lot of things in the air. A lot of people are concerned where real estate might end up. I mean, quite frankly, for the past 10 years, I've heard every day that the real estate market's going to burst. So every day there's more and more people joining that school of thought. And so, the appraisals are coming in. But now, if the seller has their property on market, they're trying to sell, or even off market, but they've been trying to sell for a while. At the end of the day, if you're coming to them with a solution for them to sell the property at the price they're looking for, and all you need is for some sort of creative terms, then you're giving them the opportunity to receive that. And above and beyond that, they can defer certain capital gains because they're not taking all the funds at closing, and they'll receive funds month over month, right? So now they've got essentially a passive income stream coming in. So very, very similar to the sub-2 conversation that most of PACE's students will talk about. The objection is essentially the same. The difference is how we're structuring the acquisition.
Okay. That makes sense. And so we're looking at it from a standpoint of, there's a lot of on-market deals that are not being sold. So how can someone approach a realtor and say, hey, how can you present this offer to your seller? And educating our realtors to make those offers. Or Jenny, you can probably answer this. Is this something you offer your clients, the Morby Method?
Not right now. Um, the listings I have, um, they're looking to net funds so they can purchase again. So the Barbie method might not work for
So
an
the
actual.
seller still does net funds. And so if we go over that like that conversation now, if and we'll use
I can give you the address. We can look at it right now. Right now, you can do a case study for me immediately.
Well,
I have one available.
let's answer some basic questions first.
Yes,
Anybody else
yes,
do have
of
it? And
course.
we do want to do case studies because I think that helps
Yes.
understand it. So before we get into that, what other questions here do we have? Or Jonathan, anything you want to chime in as far as, objections that we may have or any questions that we have, how Stephen presented the DSCR that you would have to take at 80% and how we're over leveraging the extra 30%, anything around that? Oh, Chris is here. Hey, Chris.
Yeah, I think it's so one of the objection you can face is the seller being in second position. I think Stephen mentioned that, but there's work around this. There's different objections you can overcome with this, similar to like a traditional seller finance to say, hey, we intend to keep the properties and to pay, and it's going to be an asset for us, and so we're a solid investor, we're a credibility, etc. You can go around that, or you can do the pref equity one. That's a great idea, actually, Stephen.
Hmm.
If you're okay to have Class B members on your operating agreement to manage, but yeah, I think those are two good ones. But also, I think it's to position it on like what is the seller winning in this, right? I mean, there's a lot of people that they've been sitting on their property for 6 months, and here you are, you can offer a way out immediately, like no more waiting. And also for tax advantages, right? If it's their investment properties and they're going to sell it, they're going to pay capital gains tax, potentially depending on the bracket they end up with and their income. So, like, you can help like mitigate that as well, right? So, you know,
right. Again, very similar to sub two, right?
yeah,
It's
Hmm.
really, in my opinion, no different. And in fact, it's the same exact client you're looking for. Now, the difference is, in my opinion, is in this option, instead of asking the seller to have to hold a mortgage in their own name for potentially undisclosed period of time, you are telling them we will be paying off those mortgages at closing. Those mortgages get eliminated, paid off. They don't need to worry about who's paying a mortgage
right.
in name, what happens if they miss a payment. You're telling them the mortgage gets paid off and they will net a certain amount of proceeds that you would negotiate with the seller at the time of your negotiation. So the seller gets their mortgage paid off. They get to receive proceeds at closing. And then they get to carry either a second position note, a promissory note, or a preferred equity position in the LLC, where they're going to also receive monthly income for the whatever period of time is negotiated. So I would almost argue that it's better than the sub two option because the seller does not need to concern themselves with will the mortgage be paid? Because if it isn't, quite frankly, the first position is not of not their concern. All they need to concern themselves with is their equity position taken care of? Will they receive their monthly payments? Will they receive their equity position that they're owed? And their credit isn't at stake on someone else's ability to pay.
That makes sense. Thank you, Stephen, for explaining that, and Jonathan for chiming in there. Anybody else have any questions? I know
Hey,
Edwin's got a
Stephen.
question.
No, I'm just, a lot of people jump into this creative financing thing, and it sounds like really sexy, really, really interesting, right? But it really isn't. It's not. It's not one of those get rich, quick schemes that people need to understand, right? There's a lot involved. There's paperwork, there's patience, there's precision. Anything could go wrong with this. And so, one of the things you mentioned earlier that people are tempted are, banks, the DSCR loan could go back 80% and carry back 30%, and you make that extra, 10, right, into the price of things. People don't understand that 10% of that has to go into your home, into what your or whatever the exit strategy is going to be, right? So how do you prepare somebody for something like that? How do you say, hey, um, yeah, you might have an exit strategy, say like a Burr method or seller financing or something like that, but that's when you're looking for a home. These are the way you need to structure those homes for these new guys, girls who are coming on board today, trying to learn how this Morby method works.
Really, it's just I mean I call it part of the underwriting is, what is the intended use of the funds. So, the goal isn't let me cash out as much as possible from the seller's equity and apply it elsewhere, right? So what's your intended use of the funds? And then what is the exit strategy? And to properly figure that out is we need to also know what is the seller's position, when does their note or when does their preferred equity need to be paid out, and what does that, time horizon look like? Do we have 3 years? Do we have 7? Is it 10? So what's that time horizon? Part of the diligence and underwriting is what's the market? Where's this property located? What's going to happen 3, 5, 7, or 10 years from now? Is the market growing? Is it a declining market? I'm sure many people have heard of Cape Coral is right now one of the
Yes.
most declining markets in the whole US. There was like a Wall Street Journal article about it. So where are you buying this asset? What do the numbers look like in the future? And what's your outlook? And part of all that is taken into account because we need to know how much appreciation can we expect. So not counting 2020 and 2021, year over year appreciation is between like 3 and 4%. So do that math on your piece of real estate. What does that look like? What's your value going to be in 5 years if that's when the seller position needs to be paid off? Then above and beyond that, take a look at an amortization schedule. What is your mortgage balance going to be in 5 years on that first position? How much equity do you now have? What's the seller's position? Were you paying interest only to the seller, or was the seller was their principal being paid down as well? Now take that combined debt versus against the expected property's value. Do you have an LTV that is even refinanceable at that point? Now, I can't guarantee what LTVs are going to be in 5 years as those numbers fluctuate, but based on today's numbers, the highest LTV you can get on a DSCR refinance is 80%. So if your math works out to where in 5 years, 7 years, 10 years, you're still at 95% of the property's value, well, then unless you have a very, very strong reason to refinance that property or any other exit strategy for that piece of real estate, then, I would definitely say that property, that underwriting requires a second look or a second dispo strategy, whatever the case might be. But the goal is to take a good hard look at all of the numbers. And like you said, this is not get rich quick. The goal is not to find $1 million property that you can cash out 500 and walk away, right? Like that's not the case, right? Your credit is on the line.
That's right.
Is a DSCR, your credit is on the line. You risk ruining not only your own credit, but your business credit. And that impacts your ability to buy personal residences. That impacts your ability to get business lines of credit. That impacts your ability to finance, quite frankly, anything. I would
right.
argue that credit is probably more important than having cash in the United States, because without credit, you can't get financing. But you can always find business partners to get cash. You can always find partners to work on a transaction. And so, it's really just about the due diligence. It's about the underwriting, reviewing the property properly, and making sure that you understand the pros and cons of this type of financing. Because there is no investment that is without risk, right? It doesn't matter what it is. This is just another investment strategy, another acquisition strategy that comes with its own unique pros and own unique cons. And it's all about how you position yourself and putting that kind of deal together. And if it makes sense in terms of your portfolio, if it makes sense in terms of how you're trying to scale. And yeah, that's about it. It's just in making the numbers work, right? Making sure you have a realistic seller, you've got realistic numbers, and that you still cash flow, right? So unless you're going to make the property into a pad split, or you're going to turn it into some other unique type of housing, assisted living facility, elder care facility, unless you're going to take some sort of unique approach to how you plan on making this property cash flow, you need to make sure that the market rents or short-term rents or room pad split rents are going to be sufficient to cover your total expense, not just the DSCR, but the DSCR plus the seller position, either the equity position or the seller carry note.
So more of the story is it's powerful, but it's not casual. So you got to respect the structure before you touch it.
Correct. Exactly
Yeah.
right. And so, understanding how the numbers work, understanding where the proceeds go, and then having good agreements in place are very important. Make sure everybody knows what's going on, make sure everybody's well aware of who owes what at what point in time, right? In Spanish, there's a saying, it's like cuentas claras mantienen amistades. Basically means when, clear accounts maintain friendships, right? So I use it across the board, right? If everyone's honest and transparent and as clear as possible, and everyone understands, you're able to
That's right.
maintain not just personal relationships, you're able to maintain business relationships. And that's going to help you grow and scale. And
Very
so
well said.
it's very important to know the numbers. It's very important to disclose to everybody how all of this works. And it's very important to have the right lender in place. And so, not to turn this into a case study or a deep dive into DSCR, but one of the strategies with this program is that, or not one of the strategies, I'm sorry, one of the ways that people do this transaction is when you come into a Morby method with no personal funds, at closing, there still is an exchange of down payment and closing costs to the DSCR lender. So the way these are structured, and there's a lot of moving parts, which is one of the cons to this type of transaction, is it's not just a simple 20% down closing, here's my money from my savings account. Most of these deals are being done with other people's money, using transactional funds, using gap lenders, using some third party to fund the down payment and closing costs. Because from the lender's perspective, when this kind of deal closes, the borrower still needs to bring the 20% down in closing costs, and potentially 30, 40, 50% down plus closing costs, depending on what was negotiated. And Joe's correct. Transactional funding is how we do that. So a transactional lender will fund the down payment and closing costs for the buyer, and then that transactional funder is paid back via the proceeds from the seller. And the buyer then is also going to receives the opportunity to, if they negotiated, to receive excess funds from the seller as part of the seller's carry. Not every DSCR lender allows for transactional funds to be used at closing. So DSCR, even though it's a business purpose loan, some lenders still want to see, where's the down payment coming from? Where's that money been sitting for the last 60 days? Who's the owner of the entity from which that bank account, originated? And so it's very important to have all of that lined up, not just with the lender, in this case, the DSCR lender, but with your transactional lender. How do they intend to wire the funds? Is your transactional lender going to send the funds to title? Is a transactional lender going to send the funds to a borrower owned entity account prior to closing? These are all pieces of the puzzle that need to be worked out as early on as possible, because if the transactional lender has some sort of misunderstanding or communication up front as to how they want their funds to go from their account to title, depending on how the lender structures their deal, you may, like some lenders require that the funds touch the borrower's account first before going to closing. And a transactional funder may not be comfortable putting money in the borrower account before closing, because for that split second, the borrower could dip into those transactional funds. So there is risk to the transactional funder there as well. And so structuring how that works and protecting not just the transactional funder, but protecting the seller and the buyer are all very important, with putting all of these pieces of the puzzle together to get this deal to close. Go ahead, Julie.
Just real quick. So you as a lender for Morby Method, what do you recommend as far as from your transactional lenders? And I know I have Chris here and Joe who are doing transactional lending. Do you require them to put it in the borrower's account, or can they just wire it to the title company?
I've done both. So, specifically, I'm a mortgage broker. I work with many lenders.
Mhm.
So depending on the transaction will dictate which lender I take the deal to. So the first step to the Morby method is determining who is my borrower, right? So who's my credit sponsor, who's my borrower, and that borrower may or may not fit the guidelines of lender A or B. I might have to take the loan to lender C. And that lender may have specific requirements on how funds need to be treated to get to closing. And so, you know, taking a moment to talk about DSCR, I have lenders that will allow a borrower to be a first-time home buyer and still qualify for a DSCR loan, meaning they do not own investment properties, they do not own their primary, they're currently renting their current residence, but they still qualify for a DSCR. That's unique because a lot of lenders don't allow that because there's concern that the person may be moving into the property and they have some occupancy concerns. But that lender has specific requirements on how assets need to be delivered to title. And
Mm.
so if my borrower happens to be a first-time home buyer, then I have to communicate with the transactional funder and say, if we're going to do this deal with this specific borrower, I need the funds to go to my borrower's account first, then to title. And then we'll work through whatever agreements need to be executed, and we'll work through whatever unique strategies we need to do to get the funds to title in the safest way possible for the transactional lender and for it to meet the DSCR lender's requirements for approval. And so I have on that same, that same vein, I have lenders that they're fine with the money going straight to title, but we need to show some sort of operating agreement that my buyer has some sort of interest in the entity in which wired the funds.
Okay.
And at that point, we could provide an operating agreement. There's signed agreements in place from the buyer and the transactional funder that will nullify that operating agreement shortly after closing. There's different ways to skin the cat. It's more so once I know who my buyer is,
Mhm.
I'll know what lender I could take that deal to. Once I know what lender I could take that deal to, will dictate what are the requirements that need to be met for the funds to get to closing.
Makes sense. Thank you, Stephen. Joe, Chris, anything you guys want to add on being transactional lenders?
Chris just asked something here. Have
Oh.
you allowed them to keep it in their attorney's escrow account? So I actually had that come up the other day, and I haven't been able to do that. None of my lenders will allow funds from the attorney's escrow account unless we can show where the funds originated from. So the funds can come from the attorney's escrow account, but we do need to follow it to at least a singular bank account or a singular transaction. Meaning, if the transactional funder happened to have sold a piece of real estate, or if an entity happened to have sold a piece of real estate, closed on some sort of business transaction, and we can show some sort of settlement agreement, some sort of HUD, closing disclosure, where the funds originated from. If we can follow the money at that point, then yes, I can use the attorney's escrow account. But I cannot just take an attorney's escrow letter that says, I have $1 million for Julie and I've held it for 60 days. I need to know where the funds came from. Now, that's, in my opinion, frustrating from a guidelines perspective because these same lenders are my lenders that don't source or season funds, where someone can drop $1 million in a borrower's bank account. That borrower can wire to title within 30 seconds of the money hitting their account, and I can close with no questions asked. When the funds are in an attorney's escrow account, they can't just take the escrow account at face value. They'll want to know at minimum one transaction where the funds were deposited into the account. So you're saying it should be easy to illustrate. I agree. In the instance that I'm mentioning where a transactional funder wanted to use the attorney's escrow account, they did not want to share where the funds came from. So that unfortunately didn't allow me to move forward. But if we can show one transaction, one sale, one HUD, one business sale, whatever, wherever the funds originally originated from, then I can use those funds as long as I can show some sort of ownership for my borrower or if we deposit funds into the borrower's account. So a couple of different ways to put that one together.
Very good, very good. Joe, you got a question for Stephen?
No, Steven's pretty much right on. We don't do we don't use an attorney's escrow account. We just create our own account, and we can drop the funds into a private account. The borrower can see the funds, but he can't touch them.
Yep. So I've seen that done, and we've done that on a transaction where the transactional funder did a relay bank account, created it in the entity name that was closing. Funds were dropped into that account. They were immediately wired to title. And from the lender's perspective, funds deposited, funds wired, no sourcing, no seasoning. In my opinion, that is the easiest way to go about it.
Yeah,
It's the
that's
least
quick and fast. It's quick and
Yep.
fast.
Quick and fast, easy. The funds are in the borrower's account, but the borrower can't touch it. It is, in my opinion, the easiest way. It's probably the most popular in terms of the Morbys that I've closed. But we have done direct to title with operating agreements and things like that.
I'm laughing at Chris.
Yeah, I'm reading. I'm reading that too. So yes, the Nigerian Prince offshore Swift account. We'll find a way to make that work. So
Chris.
I tell people all the time, I don't get paid unless deals close. So whatever I have to do to put a deal together, I'll help you put it together, guys. I'm a problem solver. I'll look at it every which way. I work with many lenders. I work with tons of borrowers. It's whatever we got to do to put a deal together, we'll do it.
Yeah. Stephen, let me ask you, so who is the Morby method for? Who would the Morby method fit? You said earlier when you first started, you need to find a niche and then dive in, head first. You see people jumping into what we talked about earlier. This is not a quick get rich scheme type thing. It's patience, it's learning, and once you understand this, then you can, take off from there.
So
Who is the Morby method?
I'd say the it's not necessarily that I wouldn't consider the Morby method a niche on its own. More than anything, I consider it uh, another acquisition strategy for any sub-2 student. So, a real estate investor just getting started, learning about BRRRR methods, probably not a great strategy for them, right? I would say it takes someone who's a little bit more involved with sub-2, someone who already understands seller finance, someone who already understands creative. A lot of the sub-2 students chose their niche, right? Their niche is creative finance. So even if you're a new investor, you're a student of PACE, I'm sure, taken their courses, you understand creative, and creative is very different than your traditional real estate investment strategies. And so I would say the Morby method is truly for sub-2 students as another acquisition strategy. It's a great way to take a seller that wants a very large down payment for them to even consider seller financing and being able to convert that transaction. I've seen on different forums and I've seen on different platforms deals that are trying to be dispoed that are sub-2 deals, but the seller's looking for 25, 30 for 35% down payment. And the majority of sub-2 students are always looking for the minimum down payment, right? So if I'm going to purchase a property sub-2, I want to get into it for less than 15% down, for less than 10% down. If the seller tells you, Edwin, I'm not going to seller finance unless I get at least 35% of my property's value. I need at least that much equity for me to move on and buy another property. I need at least that much equity for me to feel comfortable selling the property to a stranger. Well, the Morby method is a great way for you to say, I can put 35% in your pocket. I could put 50% of your property's value in your pocket. As long as you're willing to carry X percent based on this conversation at this rate, at these terms, well, then not only can we do this transaction, you can offer them the preferred equity position in the LLC, which can be argued that it's better than a second position note on the mortgage or on the deed. And someone had made a comment earlier, it's the win-win. You're putting the money that the seller's looking for in their pocket. You're getting the seller finance terms you're looking for, and you're getting to purchase this property with little to no money down and or potentially walking away with funds for that transaction.
Win-win situation.
Correct. And Joe said, great strategy for experienced borrowers who know how to underwrite. And that's huge. The underwriting, it is very big, understanding the numbers, understanding what rates you're getting, doing that math, and then looking at multiple exit strategies to make sure that you're not stuck holding the bag is very, very important. But to answer going back to your root question is who is this for? I see this as a great opportunity for any sub-2 student that is already calling sellers, that is already making offers, that has already been told by sellers, I'm willing to seller finance, I'm willing to sell you my property, but I need more than a 10% down payment from you. I need more than a 5% down. Well,
That's
with
right.
this, you can offer them a much larger down payment. You can offer them up to 60%, 65% down payment if they carry 40%. And you can carry,
Right.
at that point, you get to net the difference.
Yeah, that's right.
Yeah, the only caveat to that is being that the seller has to have that equity in the property.
Of course. Right. Yeah.
Yeah.
So if the seller doesn't have that equity in the property, and that's where now next week we'll do like a deep dive on case studies. We'll look at a couple different examples, a free and clear property, a case where the seller has a mortgage that needs to be paid off. So the numbers will work based on what the seller's equity position is and what liens they're paying off at closing. But the goal is to figure out what is the seller's number that they need. What is their net number for them to say, yes, I'm willing to do this transaction with those terms, and then work your way backwards. How can you get them there with the DSCR? What rate, what terms do you need to get from the DSCR position for them to net their number after settlement costs, after potential realtor fees and commissions, so that they get the number they're looking for, so that everybody gets to walk away with a win-win transaction.
Love that.
Very good.
Question
Very
for
good.
Stephen. So someone new just starting sub-2 and want to get into space and want to do direct to agent. Would they be able, what would you recommend them looking for, properties that have been on the market greater than 90, 180 days? And how can they position this to realtors, to say like, hey, is this something that we can offer their sellers since it's been sitting on the market so long?
Again, going back to like how I believe the most people are finding these deals, I see this as no different than acquiring sub-2 property or acquiring seller finance property. So yeah, definitely start with real estate that's been on market for 60, 90 days. So anything that's been on market for that long or even longer, there's a little bit more intent, I would think, from the seller. They're going to be a little more open to listening to offers. They've probably been hit with cash offers. So I know a lot of wholesalers. I know a lot of people that are doing acquisitions. Everyone starts with their anchor, right? They start with their cash offer.
Yes.
And so most people, if you're doing acquisitions, start with your anchor, start with your cash offer. Homes listed for 500, it's been on market 120 days. Tell them that I'm willing to pay 375, 350, whatever the number is, right? You start with your anchor. The seller's going to say, nope, can't do that. That's way too low. I'm looking for 500, whatever. My house is worth X, Y, and Z. Well, okay, perfect. Well, just like any other sub-2 deal, like any other acquisition, when it comes to trying to get property, that opens up the conversation to, okay, well, let's talk. I can come up on my number. Can you meet me in the creative space? Can we talk about you carrying seller position? Can we talk about terms? Will you carry at X% rate? Will you carry the following amount of time? It's no different than any sub-2 student that's acquiring property by cold calling listing agents. Start with, is a cash offer even on the table?
Right.
Then, hey, no, cash offer isn't on the table. Well, look, I have an option where we can get your seller X amount of dollars at closing. We're willing to pay commissions. We're willing to pay closing costs, get them a net number X, Y, and Z. If we can get to a table where we can negotiate, right? The goal is to bring the seller to the table first. And if the seller is been on market for a while, there's desire there. If the seller's home is a bit overpriced, just like in sub-2, there's an opportunity where it might make sense to pay a little bit over asking or a little bit over market value if there's value to you, right? So it's got to work both ways. So you might be willing to pay a little bit more if you tell the seller, fine, but instead of a 5-year note, I need a 10-year note.
Right.
That'll give you a much longer time horizon for the property to continue to appreciate. So you can get to the level where you can refinance and actually pay off whatever balances are owed. So yeah, definitely, if it's going to be MLS or on market deals, it's going to be the properties that have been on market for a bit, homes that have gotten stale, sellers that haven't heard offers in a while, realtors that are desperate to sell. There has to be some sort of intent or some kind of distress, even where maybe a creative offer is needed.
Right. Okay, thank you. Mark has a good question. Mark, you want to come off mute and ask it, or you want us to just read it?
Yeah, no, thanks, Julie. So my question is, because just looking at a couple deals and whatnot, seller equity. How much equity is, I guess, I don't know if standard's kind of a right thing, but there was a deal set up with a seller that they were going to get 5%, but then again, I've heard of another seller wanting as much as 40%, and no second lien on either one of them. But I guess what is standard, or is there a standard? So just in that minority ownership position.
So there's not necessarily a standard for the equity position. You can effectively put this kind of offer for any transaction. Now, the DSCR first position goes up to, in a best case scenario, 85 LTV. Meaning, theoretically, if the seller has anything less than 15% equity, then we wouldn't be able to move forward with the deal anyway, because we wouldn't be able to pay off the mortgage on the underlying that the seller has in the first position. So as part of our loan, we have to do that. Now, unless the seller is willing to bring funds to close to pay off whatever balance they owe on their mortgage, it wouldn't make sense for us to go that route. So I would say the minimum is going to be the 15%, but there are ways to structure this where the transactional funds could bring in the difference, pay off the outstanding balance. There could, the beauty about creative financing is you can get as creative as you need to put a deal together. And if the terms make sense for both parties, then it's all about everybody, creating win-win strategies. But to answer, I guess the question is, a DSCR in a best possible case scenario is 85 LTV. If the seller owes more than the 85% LTV, then the seller would have to bring funds to close. There would be settlement charges. So unless they have the money, it wouldn't work.
May I ask a question? Yeah. Thank you. And I guess that's favorable. What if you have 70% LTV? Would more equity make sense around that gap, I suppose? So if you have a 70, should they have 30%, equity on that specific deal?
You're saying if you have a 70 LTV DSCR lined up and the seller, you're asking if the seller should have 30% equity?
Hypothetically, yeah.
Right. So whoever the sponsor is, whoever the credit sponsor is, whatever max LTV they qualify for, when they're looking to acquire property, when they're reviewing the seller's mortgages and determining if that can be a candidate for a Morby method, whatever the max LTV they're qualifying for in DSCR is the difference is the minimum equity the seller would need to have for you to be able to even consider a Morby method.
Say that one more time.
So if you qualify for a maximum 70 LTV DSCR, then the seller would need to have a bare minimum of 30% equity for a Morby method to be viable. Because otherwise, if the seller has less than the 30% equity, then there would be funds owed to the original mortgage lender that would need to be paid at the time of settlement. So someone needs to bring those funds to close. And if it's the seller, the question would be, what structure are you putting together for that to get paid off? Because the underlying lenders need to be paid off at the time of settlement. So if the sellers don't have the 30%, then it would not work as a Morby unless you get creative and structure a way where someone's paying that difference and then payments are being made. That's, again, the creative part of that part of the Morby.
Got it. And that's if there's an underlying mortgage there. Because if they have it outright, because a couple of people and I have been looking at properties that it's 100, they own it 100% outright. So in that case, okay, great. DSCR comes to the table 70, 75, 80, whatever percent, and then use a transactional lender on that other 20, 30%, whatever. And then on that second transaction, of course, that's where you get that made up.
Correct. Right. And so, the seller either has the property paid off free and clear, or the seller has an underlying mortgage that's quite low, 30, 40, 50%. Ultimately, the DSCR needs to be enough to pay off whatever outstanding liens the seller has, put whatever minimum proceeds the seller is required as part of their negotiation, and then the difference gets funded to the buyer at the closing.
Yeah.
Yeah. But yeah, Joe said best case scenario is property's fully clear, but ultimately, we can do the deal where the seller's paying off a mortgage. The numbers need to be calculated to where if the seller says, I need to walk away with 20 grand, we have to work our way backwards. Well, how much is the underlying lien? What is the DSCR loan we're doing? What are the total settlement charges? What are the transactional fees? And what does all that work out to net seller, buyer, etc.?
Bingo. Thank you so much.
No problem.
Thanks, Mark. Anybody else have any questions? This is really good, Stephen.
Yeah, yeah, it is.
Yeah, very, very interesting structure. I'll say I kind of dove into it maybe 6, 7 months ago into the Morby method and been a little obsessed with it since. Very, very unique way to acquire property. I've seen a lot of deals put together this way, and I'm seeing a lot of investors just gobbling up Morby structured deals every week.
And it works because, you know, with the way the rates are high today, the lending is tight, and a lot of deals are just they're sitting untouched, man, because people they're playing by the old rules.
I mean,
So
the beauty
this
is, like you said, with the way rates are and how high they are, is that instead of having to bring 20% down and getting an 80% LTV DSCR, if the seller is willing to carry 35, 40%, you can get a 65 or 75 LTV loan where the terms are significantly more favorable than an 80 LTV purchase. So it allows you to cash flow better if you go that route because you're getting a much lower rate, you're getting a lower upfront loan amount, and then it's all about how you negotiate the seller position. So if you negotiate the seller at 3 to 5% interest, you're getting overall the rate between the seller, your combined rate is significantly less than if you would have just put 20% down on a DSCR, which means your cash flow is better, your monthly payments are lower. You know, you're able to squeeze more juice out of that deal.
Yeah, yeah, that's very true. Very, very true. Guys, any more questions? Just so you know, Stephen, look, you got people not just in the United States, but like we said earlier, you got Suri who's in India. Suri, what time is it over there?
Oh, so it's 4:31 a.m. And by the way, I
AM.
did not mention, yeah, Stephen, like you know me, I mean, but in the name of Justin Wolf, because I'm from private lender, and
Okay.
yeah, so I have we've been working with Stephen for a very long time, and in fact, there is a deal like right now it's going on as a profit and loss, sorry, as a bank statement, right, Stephen?
Correct.
So. So yeah, like we know each other, but not by face, but just my
Well,
alias name
it's
and
great to meet you face to face. Now I know I could put a face to the name.
yeah, yeah. So yeah, I mean, this workshop, like this kind of virtual meetup, is great for me. I mean, for me, I'm in this industry, like United States mortgage for like very long time, like 10 plus years. I started as a processor, then underwriter, for many different lenders, and then like finally landed to private lender, and now interacting with you all guys with all different kinds of information. So feeling very really well, and looking forward, to learn more. So yeah,
Sir, you've got my email and my number. I know you've
yeah.
got me. So any questions, man, I'm an open book. I'm more than happy to answer questions. Text me, email me. I enjoy doing this. I enjoy sharing information. This is a collaboration for all of us.
Yeah, yeah. I so yeah, definitely I'll ask you, I mean this transactional funding and this thing is new to me, I'll definitely deep dive on this part. So thank you so much for this session.
Of course, no problem. We'll be in touch and we'll get
Stephen,
that deal closed. Hopefully, it
Of
looks like
course. Yeah. Yeah.
Stephen, so check this out. You got Suri in India, then on the other side of you, you got Yen Boy, who is right now currently in Vietnam.
Oh, that's so interesting.
we're global right now.
Yeah,
We're international.
it's what
Yen,
we
Yeah.
Yen,
do.
unmute yourself, Yen.
Yes.
Yeah, what time is it where you're
Hi,
at?
everyone. Saigon,
What
Saigon.
time
Ho
is
Chi
it
Minh
there?
City. It's 6 a.m.
6
6
a.m. in
a.m.
Saigon.
Wow.
Four 4 o'clock over with Surya. So yeah,
4:24
Stephen,
right
you're actually
now.
global.
Yeah.
And in the mix of it, of course, you got Chris. Chris is in Vegas. You got my boy Bert popped up. What up, Bert? He's down here with us. Joe and everybody else here. So man, this is awesome. The this nobody everybody talks about the Morby method, but nobody seems to understand it quite well the way you just introduced it, right? And I'm pretty sure that what you just spoke about was just the tip of the ice cake, like the whipped cream of it. I mean,
Yeah, there
I
there's
said it earlier,
a
there's
lot.
paperwork, there's patience, there's it just man, it just blows my mind just to hear you put all this together, right? And so next week we get to talk about this case studies and see how this unfolds as we kind of put it on the blackboard for people to take a look at it the way you structure it.
Yes.
Well, I'm looking forward to it. I'm going to put together a handful of different case studies. I'm going to use actual deals I've closed, and I'll use a couple samples of different transactions of, if I see a variable that isn't involved in one of the deals I've closed, I'll create separate sample studies, and we'll go through different situations, how much the seller can net, if they're paying off debt, or if there's a property free and clear. We'll look at a couple of different LTV options and how that impacts your DSCR rate and why you might want to take a lower LTV DSCR and a higher seller position to put you in a better cash flow position.
I love it. Love it. Yana,
Yeah, love it.
question. If you give a minute again, Stephen,
Yeah, absolutely. So, if you use a credit sponsor, they would need to sign a personal guarantee. So whoever's signing on the loan as the sponsor for the transaction is signing a personal guarantee. And as for how long they'll be on the hook, however long the loan is in effect, that person is the PG. So the credit sponsor, as long as that loan is continuing being paid and has not been sold or refinanced, then that credit sponsor is on the hook for that debt.
That's cool. Thank you, Stephen. Yana, did that help?
Yeah, thank you very much. Stephen, what happens if the borrower defaults on the loan with the seller or defaults on the loan with the bank?
It will all be well, if they default on the loan with the bank is going to start reporting derogatory trades to the credit sponsor, whoever that is. So they'll start reporting missed payments. Eventually, they'll start the foreclosure process to take over the property. If the buyer or borrower defaults on the seller's position, it'll be what'll happen after is based on the agreements that are put in place. So I've seen agreements that state that the seller takes over the property immediately. There's a quick claim deed, and they all of a sudden they take the properties transferred to them. I've seen situations where there is a default period and default interest paid over 30, 60, 90 days. So the seller position is going to be based on whatever agreements get written. The mortgage is like any other mortgage. They're going to start reporting late payments, and they'll start the foreclosure process after a certain period of time to take over the property.
Gotcha. Last question. If the borrower defaults with the bank, would it go on the credit sponsor's record as a foreclosure, or since the borrower was technically an LLC, it will just stay within the LLC?
So because all DSCR loans require a personal guarantee, even though we close in the name of an LLC, the credit sponsor is still personally guaranteeing the debt. So if that loan defaults, then yes, the servicer at that point will report that default to the credit sponsor's credit.
Gotcha. Thank you very much. It was very, very interesting. Thank you.
No problem. Bert, you've got your hand up.
Bert, on mute, buddy. There you
Gotcha. Hey, great topic, Julie, Edwin, Stephen. Thanks for being here, buddy. Excellent topic.
Thanks,
Quick
buddy.
question though for the credit sponsor. Okay, I've heard a couple of myths. I don't know if they're myths or not, but as far as the credit sponsor, what would be a percentage that they would charge the homeowner if they want to use my credit? What would I have to? What would I charge them? How would I charge them?
So I've seen as a standard, I guess, and I wouldn't call it a standard because at the end of the day, if you're bringing a service to somebody, you dictate your terms, right? So if you don't feel comfortable doing anything for X% or lower or whatever it is, you dictate your terms. Now, I've seen credit sponsors offering their services at 10%, meaning they'll take 10% of any net proceeds available at closing. They'll take 10% of any equity and appreciation in the property, 10% of all net cash flow from the property and management. And at the time of sale, net proceeds, 10% of the sale. So that's what I've seen. I wouldn't necessarily call it a standard. I think I've probably done maybe 2 or 3 deals with credit sponsors. The rest have been actual buyers purchasing the property as a Morby themselves.
Okay.
And so, but at the end of the day, if you chose and decided you wanted to be a credit sponsor, you dictate your terms, just like if you're lending money. So
Right.
money, generally 12% interest only, 12-month term. But I have people that have told me that they're not willing to lend their money unless they're getting at least 14% interest. So, you dictate your terms on that.
Interesting. Excellent. Thanks, buddy.
Steven, just to elaborate on Bert's question. So, what if the borrower starts defaulting and the bank goes to a credit sponsor? Hey, you are liable. Can credit sponsor take over, protect whatever is there to kind of make a decisions to save himself from foreclosure? What are the rights credit sponsor has to make sure that if deal goes sour, he can, get out of that?
So they have every right at that point because they technically own the property, right? So they're, as a credit sponsor, they should also be on the entity documents. They would have ownership interest in the property. They would have the ability to continue to make the payment. At that point, the articles of the formation of the entity, the operating agreement, also dictate who can do what with the property at what point. And so with those agreements, I would say that any proper credit sponsor would not just underwrite the deal, they would be underwriting who their partners are, right? So, if I'm going to credit sponsor a transaction, I want to know who is going to be operating this asset. Is it someone who doesn't know how to handle rent by the room pad split? Is this their first deal? Well, what's the risk associated with that, right? So, any credit sponsor should be underwriting that. But in terms of their recourse, it's going to be based on whatever they draw up in their agreements. Those agreements will dictate what they can do in terms of if there's default or if there's potential for default. There should be, in my opinion, an assignment of rents. There should be some sort of documentation that allows them to manage any kind of bank account. And this is my personal opinion, I am very protective of my credit. So I would be incredibly, incredibly difficult if I was going to be a credit sponsor, I would be underwriting it. I would have all kinds of protections in place. I would make sure that, again, not just underwrite the asset, underwrite who is the operator. I need to know, have you operated this type of asset? Do you know what you're doing? Do you know, can you stabilize this property? What is our end goal and how are we going to disposition this property? And what is my cut going to look like at that point? And so, how do you protect yourself as a credit sponsor? Put it all in writing. Maintain clear, transparent communication with everyone involved. Make sure that the documents are fully written on paper. Have an attorney review, however you feel comfortable, and make sure all of that's in writing and signed off. I'm not a big fan of handshake deals for big business transactions because things get lost in translation, right? Black and white, pen and paper in writing is the best way to go about it, in my opinion.
Yeah, cool.
We have one more real quick from Chris. Do you work with lenders that won't freeze the draws? Oh wait, I jumped. Sorry.
So that sounds, Chris, like you're talking about like a fix and flip loan. Like it draws in terms of like rehab or construction draws. Now I don't see that Chris is. Oh, you're still here, Chris. My bad. I see you now. Sounds like you're talking about a fix and flip loan. Is that what you're asking about?
Yeah, it's just if you there's certain hard money lenders, right? That'll, if they find out there's a second lien on there, they're going to freeze the draws, and then it's a pain in the butt. So I'm just trying to. What are the majority of the ones you work with? Do you have some to avoid like that?
So I can tell you, I have not done a Morby method on a fix and flip deal where the underlying first position was a fix and flip transaction. So I don't have an answer for you to tell you one way or the other. Every single Morby I've done has been a DSCR first.
Okay. No problem. But you're doing other than Morbies as well, right? You're facilitating all types of loans or no?
Yeah, so I do
Okay.
have fix and flip financing available. I do offer bank statement loans, profit and loss loans. I offer the whole gambit, right? As a mortgage broker, I have access to these products. But for the Morby method specifically, it's been strictly DSCR.
All right, groovy. Sorry, I should have stayed on topic.
No problem. Don't worry about it.
Wow, that's amazing. Guys, I just dropped Steven's one pager in the chat, so you can reach out to him for any questions. I mean, he's the Morby Method King. So um, thank you guys so much for coming. Next week we are going to have part two. Jenny, bring your deal. Steven, let's underwrite that for her so she can see an example so she can get more clothes. But yeah, guys, this recording will be up hopefully within the week. So give your love to Steven, reach out to him. He's super helpful in the community. And
He
Steven,
is.
thank you so much. Thank you all so much for being here. We appreciate it.
Appreciate
Thanks,
you
Stephen. Thanks
guys.
for
Thank
coming,
you,
brother. We'll
Julie.
see
Thank
you
you,
next week.
Edwin. Take care, everybody.
See y'all next week.
See you guys.
Have a
Bye-bye.
good one, guys.
Bye.
See you, Bert.
Thanks, guys. Get some sleep.